The money you think is there disappears exactly when you need it most. On September 15, 2008, Lehman Brothers held $639 billion in assets that appeared completely liquid according to every conventional measure. The investment bank's portfolio included government bonds, corporate securities, and mortgage-backed instruments that traded billions of dollars daily in active markets. Sophisticated risk models calculated that Lehman could liquidate its entire portfolio within 48 hours if necessary, providing mathematical certainty about asset convertibility during any conceivable stress scenario. When Lehman attempted to sell those assets during its final weekend, buyers simply disappeared. Securities that had traded $50 billion daily became completely unsaleable at any price. Government bonds that represented the foundation of global liquidity became as unmarketable as expired lottery tickets. Within 72 hours, $639 billion in liquid assets became worthless, not because of fundamental value changes, but because liquidity itself proved to be mathematical impossibility when tested under stress. Lehman's liquidity evaporation wasn't isolated market dysfunction or temporary trading disruption. It was mathematical demonstration that liquidity represents the financial system's most fundamental and dangerous lie. When markets claim infinite liquidity during calm periods but provide zero liquidity during stress periods, they reveal that liquidity is psychological illusion rather than mathematical reality. Understanding liquidity as systematic lie rather than market feature requires examining the mathematical impossibility of maintaining asset convertibility when multiple participants attempt simultaneous liquidation. Liquidity depends on mathematical asymmetry between buyers and sellers that breaks down precisely when liquidity becomes most necessary for system stability. The mathematical foundation of liquidity requires continuous presence of willing buyers who can absorb selling pressure without causing significant price disruption. This mathematical relationship depends on buyer confidence remaining stable while seller pressure increases gradually rather than simultaneously across multiple market participants. But mathematical analysis reveals that buyer confidence and seller pressure operate according to correlation patterns that make simultaneous liquidity impossible during stress periods. When stress increases seller pressure, it simultaneously reduces buyer confidence through identical psychological and economic mechanisms. The mathematical relationship guarantees liquidity disappearance when selling pressure reaches critical thresholds. Historical analysis demonstrates that liquidity evaporation follows mathematical patterns that appear universal across different markets, time periods, and asset classes. The 1929 stock market crash, the 1987 Black Monday collapse, the 1998 long-term capital management crisis, and the 2008 financial breakdown all demonstrated identical mathematical patterns of simultaneous liquidity disappearance across supposedly independent markets. The mathematical progression follows predictable sequences. Rising stress creates selling pressure that initially meets adequate buyer demand. Continued stress increases selling pressure while beginning to reduce buyer confidence. Critical stress levels create selling pressure that overwhelms diminishing buyer demand, causing liquidity to evaporate completely rather than gradually decline. Modern financial engineering has created liquidity illusions that exceed anything in financial history through complex instruments and trading systems that promise instant convertibility while creating mathematical conditions that guarantee liquidity failure during stress periods. Exchange-traded funds, algorithmic trading, and derivative markets represent systematic liquidity lies that will fail more completely than historical precedents. ETF liquidity represents the most dangerous contemporary example because ETFs promise instant share redemption while holding illiquid underlying assets that cannot be sold quickly during stress periods. When ETF shareholders attempt simultaneous redemption, The mathematical impossibility of liquidating underlying assets creates liquidity gaps that make redemption promises impossible to fulfill. The mathematical structure of ETF liquidity depends on redemption requests remaining small relative to daily trading volumes while underlying asset markets maintain normal liquidity conditions. When redemption requests increase substantially or underlying markets become illiquid, ETF liquidity disappears through mathematical relationships that make share convertibility impossible, regardless of portfolio value. Bond ETFs demonstrate this mathematical impossibility most clearly because they hold corporate and government bonds that trade infrequently in normal conditions and become completely illiquid during stress periods. When bond ETF shareholders demand redemption during market stress, the underlying bonds cannot be sold at any price, making ETF share redemption mathematically impossible despite stated liquidity promises. High-yield bond ETFs amplify this mathematical problem because they hold bonds that become worthless during economic stress, while promising daily liquidity to shareholders who expect instant access to their investments. The mathematical contradiction between illiquid assets and liquid liabilities creates systematic conditions for ETF liquidity collapse that exceed traditional bond market failures. Algorithmic trading systems represent another category of liquidity lie because they promise to provide continuous market liquidity through automated trading while creating mathematical conditions that guarantee liquidity withdrawal precisely when markets become stressed. Algorithms programmed to provide liquidity during normal conditions automatically withdraw liquidity when predetermined risk thresholds are exceeded. The mathematical result creates liquidity that exists only when unnecessary while disappearing when essential. Algorithmic liquidity providers operate according to risk parameters that force simultaneous withdrawal when market conditions deteriorate, creating liquidity evaporation that amplifies rather than dampens market stress. High-frequency trading algorithms promise continuous price discovery and market liquidity through rapid transaction processing, but their mathematical programming includes risk controls that require immediate trading cessation when volatility exceeds algorithmic comfort levels. This creates systematic liquidity withdrawal precisely when continuous trading becomes most necessary for market stability. The mathematical contradiction embedded in algorithmic liquidity provision means that computer-driven markets provide more liquidity during calm periods, but less liquidity during stress periods compared to human-driven markets. Algorithmic risk management creates mathematical certainty that liquidity will disappear when most needed for system functioning. Cryptocurrency markets demonstrate liquidity illusion through digital exchanges that promise instant conversion between cryptocurrencies and traditional currencies while lacking mathematical infrastructure necessary to support large-scale liquidation attempts. Most cryptocurrency liquidity exists only for small transaction sizes, while becoming mathematically impossible for institutional-scale redemptions. The mathematical structure of cryptocurrency liquidity depends on finding buyers willing to purchase digital assets at current prices while ignoring fundamental questions about cryptocurrency value sustainability. When buyer confidence disappears during stress periods, cryptocurrency liquidity evaporates more completely than traditional asset markets because cryptocurrencies lack underlying productive assets that provide value floors. Bitcoin and Ethereum markets demonstrate systematic liquidity concentration, where 90% of trading occurs during favorable conditions while liquidity approaches zero during unfavorable conditions. The mathematical distribution creates liquidity illusions during normal periods while guaranteeing liquidity unavailability during crisis periods when conversion to traditional currencies becomes necessary. Stablecoin liquidity represents the ultimate cryptocurrency liquidity lie because stablecoins promise convertibility to dollars while holding reserves that cannot be liquidated quickly during stress periods. When multiple stablecoin holders attempt simultaneous redemption, The mathematical impossibility of converting reserves to cash creates stablecoin devaluation that defeats the entire stability premise. Central bank liquidity provisions represent institutional recognition that market liquidity constitutes mathematical impossibility rather than market failure. But central bank interventions create additional mathematical problems through monetary expansion that reduces currency purchasing power while attempting to maintain asset liquidity. Federal Reserve quantitative easing programs demonstrate mathematical attempts to solve liquidity problems through currency creation that makes asset markets appear liquid while destroying currency value. The mathematical trade-off exchanges asset liquidity for currency debasement, creating systematic inflation that reduces real returns while maintaining nominal liquidity. Central bank liquidity provision operates according to mathematical principles that require currency debasement to maintain asset market functionality. When central banks provide unlimited liquidity to prevent market breakdown, they mathematically guarantee currency breakdown through monetary expansion that exceeds economic productivity growth. The European Central Bank's negative interest rate policies demonstrate mathematical recognition that traditional liquidity mechanisms have failed completely, requiring currency destruction to maintain asset market functionality. Negative rates represent mathematical acknowledgement that normal liquidity relationships cannot be sustained without systematic savers' wealth destruction. Bank of Japan quantitative easing policies spanning decades demonstrate mathematical impossibility of restoring normal liquidity relationships once financial systems reach certain distortion levels. Japanese monetary policies have created asset market liquidity through currency policies that guarantee continued economic stagnation through mathematical mechanisms that prevent normal economic functioning. Commercial bank liquidity represents another category of systematic liquidity lie because banks promise depositor access to funds while lending most deposits in illiquid, long-term investments that cannot be quickly converted to cash during crisis periods. Fractional reserve banking creates mathematical conditions that guarantee bank liquidity failure when substantial numbers of depositors attempt simultaneous withdrawals. The mathematical structure of banking depends on depositor withdrawal requests remaining small relative to total deposits, while bank investment portfolios maintain normal market values. When depositor confidence declines or bank investments lose value, fractional reserve mathematics make bank liquidity impossible regardless of underlying asset quality. Regional bank failures during 2023 demonstrated banking liquidity illusions through banks that appeared mathematically sound until interest rate increases reduced bond portfolio values, while creating depositor confidence problems that triggered bank runs. Silicon Valley Bank, First Republic, and other failures showed that banking liquidity disappears rapidly once mathematical thresholds are exceeded. Government deposit insurance programs represent institutional recognition that banking liquidity constitutes mathematical impossibility, but deposit insurance creates additional mathematical problems through government guarantee programs that exceed government financial capacity during widespread banking system stress. FDIC insurance covers approximately $9 trillion in deposits while maintaining reserves of approximately $100 billion, creating mathematical coverage ratios that make deposit protection impossible during systematic banking failures. The mathematical impossibility requires government currency creation to fulfill deposit insurance promises, creating inflation that reduces deposit purchasing power while maintaining nominal deposit values. Money market fund liquidity demonstrates mathematical impossibility through funds that promise daily redemption while investing in commercial paper and short-term securities that become illiquid during credit market stress. When multiple money market investors attempt simultaneous redemption during crisis periods, underlying asset illiquidity makes fund redemption promises mathematically impossible. The 2008 Reserve Primary Fund collapse demonstrated money market liquidity illusion when fund investors attempted simultaneous redemption while underlying commercial paper markets became completely illiquid. Government intervention prevented broader money market system collapse but required taxpayer support that exceeded normal market liquidity provision capabilities. Pension fund liquidity represents systematic institutional liquidity lie because pension systems promise benefit payments while investing in assets that cannot be liquidated quickly during economic stress periods. When pension obligations exceed liquid asset availability, benefit payment promises become mathematically impossible, despite accounting statements that suggest adequate funding. Pension fund mathematical structure depends on contribution inflows exceeding benefit outflows, while investment portfolios maintain values that support long-term obligation fulfillment. When demographic changes reduce contributions or investment losses reduce portfolio values, pension liquidity disappears through mathematical relationships that make benefit promises impossible to fulfill. Real estate investment trust liquidity demonstrates mathematical impossibility through REITs that promise daily share trading while holding commercial real estate that requires months or years to sell during normal conditions and becomes completely unsaleable during stress periods. REIT share liquidity exists only as long as new investors continue purchasing shares rather than seeking actual redemption for underlying real estate values. The mathematical contradiction between daily REIT share liquidity and underlying real estate illiquidity creates systematic conditions for REIT collapse, when share demand disappears while underlying properties cannot be sold to meet redemption requests. REIT liquidity represents pure mathematical illusion that depends on continuous buyer confidence rather than asset convertibility. Understanding liquidity as systematic lie rather than temporary market disruption provides insight into why financial crises consistently exceed policymaker expectations and intervention capabilities. When liquidity evaporation occurs simultaneously across multiple markets and asset classes, the mathematical scope of intervention required exceeds what any institution can provide without destroying currency values through unlimited monetary expansion. The mathematical pattern of systematic liquidity failure demonstrates that financial systems are fundamentally more fragile than conventional analysis suggests, because liquidity represents psychological confidence rather than mathematical reality. When confidence breaks across multiple markets simultaneously, liquidity disappears faster and more completely than mathematical models predict. Current financial system liquidity depends on mathematical relationships that have become more unstable than any historical precedent, because modern financial engineering has created liquidity promises that exceed what underlying asset markets can fulfill during stress periods. ETFs, algorithmic trading, cryptocurrency markets, and complex derivatives represent liquidity lies that will fail more spectacularly than historical precedents. The mathematical inevitability of systematic liquidity failure means current financial system stability depends on maintaining confidence in liquidity promises that cannot be mathematically fulfilled when tested. This creates systematic fragility that guarantees financial breakdown will occur when sufficient numbers of market participants simultaneously test liquidity promises. Historical analysis demonstrates that systematic liquidity crises occur approximately every 10 to 15 years, because financial system complexity increases continuously while underlying asset liquidity improves slowly or deteriorates. The mathematical gap between liquidity promises and liquidity reality creates periodic crisis episodes that reset financial system complexity to levels that underlying asset markets can support. Current financial system complexity suggests approaching systematic liquidity crisis that will exceed 2008 precedents because liquidity promises now extend across more markets, more asset classes, and more institutional structures than existed during previous crisis episodes. The mathematical scope of potential liquidity evaporation exceeds what any intervention capability can address without destroying currency systems. Mathematical analysis of current liquidity relationships suggests systematic breakdown probability increasing rapidly because multiple asset classes simultaneously exhibit liquidity characteristics that historically preceded individual market breakdowns. When bond markets, equity markets, commodity markets, cryptocurrency markets, and real estate markets all demonstrate liquidity illusion simultaneously, systematic breakdown becomes mathematical certainty rather than remote possibility. The financial system's most dangerous lie isn't complexity, leverage, or speculation. It's liquidity. The promise that assets can be converted to cash when needed represents mathematical impossibility that becomes obvious only when multiple market participants attempt simultaneous conversion. The money you think is there disappears exactly when you need it most, because liquidity exists only as long as you don't need to test it. Mathematical reality operates independently of financial engineering, sophistication, or regulatory oversight. When stress reaches sufficient levels, liquidity evaporates according to mathematical laws that make market functioning impossible until confidence returns or intervention restores artificial liquidity through currency debasement that solves liquidity problems by creating currency problems. The mathematical certainty of periodic liquidity evaporation means financial system stability represents temporary illusion rather than sustainable condition. Current liquidity promises exceed mathematical sustainability by margins that guarantee systematic breakdown when confidence breaks across sufficient market segments to overwhelm intervention capabilities through simultaneous liquidity demands that cannot be fulfilled mathematically.